For those of you who don't know, I'm Demetri Demascus. No, I'm being told not to start. Hold on. Let's just wait till 3. Get started. So for those of you who don't know, I'm Demetri Demascus, the co-founder and editor of PROFILEmiami. We're a Miami-based news and events real estate platform. This is our COVID-19 impact on commercial real estate in South Florida webinar. This is the first webinar we've done. We're going to start getting them going, hopefully weekly. Today we have some special panelists. We've got Michael Fay. He's the principal and managing director of Avison in Miami. We have Thomas Wood. He's the president of Thomas D. Wood & Company. And Jacques Bessoudo. He's the managing partner and founder of Galium Capital. I'm going to let each of the panelists give a quick little 2-minute introduction of themselves, who they are, their company, and then we'll get rolling. So let's start with Thomas, since you're in the top left.
Sure. Greetings, everybody. Hope everybody's staying safe and finding something to do. My name's Tom Wood Jr. I'm the president of Thomas D. Wood & Company. We're a commercial mortgage banking firm. We represent 24 insurance companies. We originate debt and also service the loans, primarily in Florida. We have exclusive correspondents in Florida. We also do CMBS, bank financing, bridge, equity, you name it. On the debt side, we do it. We've been in business since 1987. We have 20 employees scattered throughout Florida. And this is actually kind of nice for me because I don't have to answer any borrowers' phone calls for the next hour looking for relief. So look forward to the talk and telling you guys what's really going on out there.
Great. Let's have Jacques.
Perfect. Yeah, this is Jacques Bessoudo with Galium Capital. We're a commercial real estate investment company based in North Miami. We buy mainly cash flow generating properties. Half of the portfolio more or less is rental housing, multifamily. And the other half is mainly the commercial properties, mainly office. Yeah, thanks for having us, Demetri, and organizing this.
Definitely. And Mike?
Great. Michael Fay, Managing Director of Avison Miami, but also the Chairman of the U.S. Capital Markets Group Executive Committee. We're seeing a lot of great things going on that we'll be able to talk about, but our firm and our team really focuses on all capital market investment sales across all product types. We've specialized more in the client relationship than the product type. We've also been handling distressed real estate for 30 plus years. Tom Wood and I literally started our company, Wood Fay Real Estate Group, back in 1989, a couple years after he started the mortgage banking firm, and we had a lot of fun over those years. So Tom and I feel like we're back in the band again, doing the stuff. But for us, Avison Young, I also am the national director for the asset resolution team, which comprises about 175 folks around the country in the major markets and tertiary markets.
Excellent. And you just got knighted, right? Can we say that?
I did get knighted, yes. I am a Knight of Malta, which I'll be a rotating person on the United Nations, one of the United Nation groups, as well as an ambassador to, it looks like, Cayman and Bermuda. So we'll see. It's all going to be very diplomatic stuff, but kind of fun.
Nice. Very cool. So we'll get started with essentially the first question, which is, I think, on the top of everybody's mind. But where is the commercial real estate market today?
Tom, you want to go or you want me to go?
I'll tell you from the lending side, since I'm not on the real estate side anymore, thank God. The lending side, it's total chaos right now. What you're having is this pyramid effect, so to speak. The tenants aren't paying the landlords, and the landlords are reaching out to the lenders for some type of relief. I'm hopeful that this COVID-19 thing goes away in April. So this is a short-term disruption. If it's a short-term disruption, I think we'll all be fine. But April is going to be a complete shit show in the markets, and everyone's got to learn to have a calm head. And if you're a borrower, you need to understand your property and understand your rent roll, because you just can't make a phone call to a lender and expect the lender just to roll over. You need to actually explain your issues. in detail. And we'll go into that in a little more detail later, but I think long-term, if we can get out of this, or at least have some clear direction and get out of it in May, maybe mid-May, I think we'll be okay. It'll be some short-term disruption for the people that didn't have a lot of equity in their deals or were over-leveraged. But if it goes past May, all bets are off and it could get really ugly out there.
Great. Mike, do you want to chime in?
Yeah, absolutely. So first of all, being in the distressed real estate business for the past 35 years, this is totally different in a lot of ways, but it's also how we have to handle issues. You know, as Tom was mentioning, the lenders, you know, we do a lot of work with banks. We do a lot of work with special servicers, all on the distress side. We have been so busy over the last 2 weeks handling already premature calls on what to do and what to handle. The servicers are receiving anywhere between 50 to 100 phone calls a day from borrowers, the special servicers, and the master servicers are already getting the phone calls of how they cannot handle the payments. They're not going to make the payments. We've got issues with tenancy that's going on. There's a lot of weakness in the market. It's $2 billion plus just coming to L&R alone for, the hotels. But, you've got issues on retail, you've got issues on student housing, you've got issues on office coming up, as well as, even industrial, but multi-tenant warehouses that have got more manufacturing tenants. And lastly, on the multifamily side, there's been all sorts of discussions about how much rents are not going to be paid for April and May, and this could be up to 40%. So it'll be interesting, especially with the governor turning around and stopping all foreclosures and also evictions for the next 45 days. So there's a lot of things going on, and I think that we've just got to be patient. We've got to look for opportunities. We've got to help the clients. So there's a lot of things that are there that we're going to have to get into, and I'll talk more about that and more of the nuances in a moment.
Great. Jacques?
Yeah, I just want to say, in addition to what has been said, I agree with Mike that there's issues across asset classes. But I think the depth of those issues vary a lot by asset class, right? Like if this is a mid-May thing and I buy it in a single day, Tom, hotel and some parts of retail are worried about the rebound and how the rebound will take place, and they're really worried about safeguarding the asset in the long term. While if you're in more defensive asset classes like multifamily or some types of office or industrial, yeah, you're worried, but you're probably just worried about the short-term cash flow situation and how much rent you're going to be getting in April. But you're probably yet not too worried about the long-term strength of your assets. So it's a big difference.
I'd like to add something here. One of the major issues is, and Tom and I and others have talked about this, the issue that we have is there is no one situation that is the same, and there's no one fix that's the same. What do I mean by that? The banks are a part of the stimulus plan. The banks can give out all sorts of relief, and they are doing it. So that's already happening. The CMBS market, as Tom will tell you, and we know, they have no idea what's going on, and it's day by day, hour by hour. So that creates another issue. And then you've got life insurance companies, which Tom is involved in dramatically on. We're seeing different issues, whether it's a mutually owned or stock owned. We're having conversations across the board. And then you've got also the other larger institutional houses that are trying to figure out what they're doing with their partnerships, where they actually are the lender and also the partner with the sponsor on the deal. So there's a lot of things going on, and there's really, it's going to be very interesting to see how this works, as well as how the courts are going to handle this during the time of relief. So, and we'll talk more in a moment, but I wanted to highlight those variations as well, not only product types, but also lender types.
Cool. Well, I think the listeners will get the most value if this is more of a discussion amongst you guys about this. All of you are exposed. Your businesses are definitely going to be affected in one way or another. So let's touch on some of the metrics, the timing, overall leverage, some of this stuff, and just get a discussion going.
In my world right now, the issues as follows. The FDIC and the credit unions all got together, and they they were probably first to the workout side, and they're able to give out deferment, 90-day deferment with kind of like confetti. It's everywhere. So the banks and the credit unions are way ahead of everybody, and they're able to help their clients out. The regulators for life companies, the NLAIC, is a little behind schedule. They're trying to rule this week. They're not able to do much as far as deferment yet, but I expect by next week they'll be able to follow in a similar pattern like the banks, though I think you'll have to provide information to show that you're actually harmed, where a lot of bankers are just giving out the 90 days whether you're harmed or not. And then you have CMBS, which if you ever had a CMBS loan, good luck. You got to get the master servicer to get to the special servicer to get to somebody that's a decision maker. Some guys would probably tell you the best way to get movement on that is to go in default. I never like to encourage my borrowers to go in default, but I would write a letter to your master servicer right away saying that default is imminent, and that might be the best way to do it. From our standpoint, we collected all of our April payments, and we're now working with all of our clients for relief from May through the August timeframe. Right now, IO is on the table for retail. We're trying to get deferment for hospitality. Those are the two biggest asset classes we see that are harmed. Yet, believe it or not, we're getting calls now from industrial, office, every asset class there is, because I call it the pile-on approach. They're tenants that are in, but why pay rent? Nobody else is paying rent type of theory. So this is going to be, like I said, April is going to be a very difficult month. And I think if there's no clear direction, May could be probably the biggest default month in the commercial real estate industry. So from there, we go to the distress side. But right now, we're focused on, probably the biggest thing we're focused on is talking to our borrowers to learn about all the programs that are out there. The PPP, the PPPs was out finally today at about noon. We're passing information on all our borrowers for their tenants, because all their tenants should be all over this PPP program if they qualify, which is less than 500 people. And we're trying to be proactive with our clients so that the borrowers know that in this PPP program, there's forgiveness of debt. And in one of the items that is forgiven is either mortgage interest or rent payments. So right now, we're not worried about as much the stress side as kind of to decide to make sure our portfolio stays healthy, because we have a 500 loan portfolio at about $1.4 billion. And I don't know if you guys know, but working out 500 loans is quite time consuming.
So one of the interesting situations also, as Tom was talking about, is how this starts to snowball into each group. And I'll give you a couple of conversations that we've had with certain owners, investors, and borrower and lenders. The first is when you get to a point and you're not going to make your mortgage payment, they're going to make sure you're a good steward of that property. You've got bad boy carve-outs, you've got all sorts of things. Tom's laughing. I can see him on the screen right now.
I have smart-ass nephews sending me texts right now. So.
Yeah, so
CMBS lenders, that is, smart-ass CMBS nephews.
Yeah, exactly. So what happens, though, quite frankly, is that, you get these situations where it starts to snowball. And when it snowballs, you've got, are you going to put a capital call to keep all the life safety issues going on? A lot of groups are like, we have no money for your old deals, but we have lots of money for new deals. So you're going to start to see, I think, some mentality shift of what are they going to do with their assets as they further get down the road and understand the texture and the risk analysis all the way down to where it could be, all the way out to the end of the year. So I think each month that we go through this, it's going to continue to snowball. Well, Tom was talking about May. I would totally believe May will be the biggest, but I continue to see that there's going to be many, many more over the months that come up. So it's very interesting in the snowball effect, and who's going to really say, I'm going to sell now, even though they may not be totally distressed, and try to preserve as much equity as they can, or do they move on and just kind of deal with what they got and try to build up the value of the asset again? It'll depend on the values, and of course Tom will tell you it'll depend also on the loan to value ratios.
I'm interested to hear your opinion. With us, basically every single lender has issued deferment programs, but we so far have elected not to participate in them, and we're trying to cover expenses and mortgage payment through like first quarter's cash flow or current cash flow, because we fear of any negative implications that it might have. So have you seen, A, do you think there's any negative implications in participating, and B, have you seen owners all taking them, or are they just like wait and see?
Okay, I could answer that easily. First of all, it depends on the lender. If it's a bank, they're giving it out like water, so I'd be the first guy to tell you to take it. Okay, I mean it's never going to go against you or anything. When it comes to the life companies and CMBS, I would tell you for sure make your April payment. Okay, because April payment is for your March interest. You collected your rents most likely in March, and then I would then make a call to your lender and say, look, after you see what the damage is to your rent roll in April, and I said, when you see what your damage is in April, I'd make a call immediately to your lender and say, look, I need some form of relief. Not all of them can offer deferment. Some might only be able to go IO, interest only. But you need to show the rent roll and the damage that you have based on your rent roll due to the COVID-19 issue. So if it's a bank lender that's your lender, definitely ask for the deferment if you feel harmed, or you see it coming, because it's no skin off their back. The FDIC is backing them 100%. If it's a life company, we're not there yet. We're probably real close for hotels, and we're probably at IO for retail right now. I'm sure that'll change a little bit more aggressive as the month progresses. But right now, I think the most important thing for everybody that's an owner is to pay attention to your rent roll, because a lot of your tenants are going to try to pile on this issue, even though they're not harmed at all.
I want to highlight one thing. If you're a tenant and or a borrower, get used to your landlord, depending if they're an institutional landlord or a localized landlord, they're going to send you questionnaires of understanding your business, understanding your harm, understanding, are you going to really make it back? What are you doing to be proactive? And as Tom says, participate in the stimulus, the CARES program. That is something that's really important. And as he said, the banks are giving it away. So, that doesn't hurt you. But I will tell you, understanding and seeing some of the larger institutional groups, they're sending out extensive questionnaires to really understand to the borrower and or to the tenants to do this. So I think if you're going to do this, be smart about how you answer these, because it could affect you long term from a relationship standpoint, or also what other decisions they're going to make about other relief, and either making you fail or not fail. So it's very interesting.
That's a great.
And definitely have your financials in order. So make sure you have year-end 19 done, year to date, maybe at least through February done, and then be prepared to send in exactly why you need it, why you need assistance. I mean, they're just not going to give it to you. The banks are pretty soft, but you're just not going to get it just for asking for it. You got to prove some type of damage.
Right. Perfect.
Jacques, could you talk a little bit about the restaurants and retail? I know you've got a little bit of that in your portfolio, and maybe how it compares to some of the other asset classes that you've invested in.
Yeah, we have just a little bit. We have 2 service centers that we own and manage, and for we are probably 40% open in terms of like the tenants that we have, and this is restaurants, doctors. We have gyms that are closed. We have salons, like all those types of service tenants. But like most of them, yeah, they're closed and they're not getting any business. But there's a portion also that are getting some type of business, at least some that is, it's allowing them to pay rent, and many of them are even doing more business than they were before because of the nature of their business. You drive by the plazas that we have, and they seem pretty full. Like you wouldn't think that they're completely shut down. I would say around 5 or 6 tenants only have reached out asking for aid. We're working with them. First thing, we're referring them to the government aid programs, because with this programs, they can get support to pay rent, but we can't, right? So we're just trying to guide them. This is small businesses, so trying to guide them to get that support, so that they continue open, they don't suffer, and we don't suffer. Because I mean, we would love to do more. For some of them, we're doing deferments. We would love to do more, but we also have to pay mortgage and expenses, right?
Cool.
Demetri, what the real issue is if you think about it, if I spend my entire month doing workouts and cleaning up borrowers, there's going to be absolutely no production going on the lending side. Might as well get into that. Think about it. To get a loan with tenants, you got to get estoppels. If you're trying to close a loan in say June, how are you going to get the estoppels? And I wouldn't be surprised if you're trying to buy an apartment complex, nobody's paying rent because they can't be evicted. So if you think about it from a broker standpoint or a transactional standpoint, it's just going to fall off the cliff in May, June, and probably July, just because it takes 60 to 90 days to close a deal. So what you may see out there is you may see some nervousness from either some clients or what have you, to where pricing is going to get pretty tasty. And as I've always said, when the market's this hot as it was, the smart guys are on the sidelines with a lot of capital. So you're going to see cap rates probably go screaming up from where they were. But there's going to be a lot of risk associated with the transaction if you believe COVID is going to stay here forever, which I don't. But it's a great opportunity if you have capital, because I think there are going to be some, especially take the hospitality side, they're going to be, those cap rates are going straight up. There's going to be deals in retail. Okay. It's going to be, I think it's going to be an exciting market for people that have capital. So for the acquisition people out there, I'd be trying to go out and identify capital sources that you can go to war with in the marketplace, because there'll be some guys that just didn't save for a rainy day. It's shocking to me that people don't have it sounds like Demetri's ready, but there are people that don't have a month's payment ready to make. And you probably shouldn't own commercial real estate if you're running that tight. So, that's something to think about.
I want to highlight something real quick on a couple of other issues that we're seeing, but also give you a little bit of market texture and color here. Our team does about $1 billion a year in deals, which is myself, John Crotty, David Duckworth, and the rest of our team. And what's interesting is we've had, it's been a tale of 4 or 5 cities. What does that mean? We've been closing land deals literally in the last couple of days, in the last week. We've been closing a couple of other, single tenant or office type deals that were already teed up. What was interesting on one of those deals, these are $15 million deals, $20 million deals. Some of those deals, what was interesting is that the lender was a bank, had no recourse or limited recourse. Then literally the day before closing and commitment, they said, nope, we're going full recourse. So they've had some of those changes. And one of the other interesting parts of this is we're seeing a lot of groups that have just said, look, we're under contract. We'd like to have a 45-day hold period. We just want to pencils down for 45 days. Let us see what's going on. Some of the sellers have said, no problem. We'll keep the contract in place. Some have said, no problem, but we're going to fall out of contract. We'll be back to you later on. And we've had a couple of others, even today, where we've had deals that are going to go at risk. And they're asking for anywhere between a 5 and 10% haircut on the price. So we're seeing a little bit of that price weakness, but also they don't want to lose some of their lending that they've already got in place for this. And as Tom says, getting the deal closed is going to be a whole other thing, because you've got to go through and get estoppels and other situations. So some of the larger difficult deals like retail, multifamily, hotel, it's going to be hard to get those deals closed. But I think there are going to be other deals that are closing. Industrial is still doing very well across the board right now. There's still transactions that are taking place. We know of some larger leases that are still being done. But it's just everybody is proceeding with an unbelievable amount of caution. And looking to see what the world will hold for further opportunities.
I know you guys had mentioned that, Jacques, what were you going to say? Sorry.
No, I was just gonna talk about the opportunity thing for a second. I think so. What we are seeing is more opportunities in the short term in terms of like buying really good assets that otherwise you wouldn't be able to do because they'll probably go to a big institutional buyer, like that core multifamily building in downtown, right? Like that kind of stuff. Because a group like ours, for instance, we're very agile, taking decisions, and we have capital committed. So we see that type of opportunity, but not as much on the pricing side, at least in the short term. Like if you look at the previous crisis, the real pricing opportunities took 12, 18 months to come, and that is without the federal programs that we have now that are very likely going to delay foreclosures compared to the previous crisis. So we do see, and on top of that, there's so much liquidity in the market that every company that is in the investment side that you talk to, they're like just waiting for this opportunity to try to deploy all the capital that they haven't been able to deploy over the last 2-3 years. So
you're right about that. I think that we have more capital today than we had before. We also, the banks are stronger than what they were. Life companies, everybody was much stronger and has got a load of. We just need the capital markets, the financial markets to settle down, both on the lending side, in the spreads, but also, the stock market. So once you get a little bit of clarity and we start to have, just a better mental mindset. If you look at the VOX index, the volatility index, the volatility index has been dropping, but it goes up and it goes down quite a bit. And I think this is just a mental mindset. We're all sitting here at homes, trying to work and trying to do this. One thing, we are blessed as real estate practitioners to be able to be doing what we're doing. We can do this from home, and we can be doing what we're doing right now, which is sharing information, which is talking about opportunities and talking about risks, and be able to push this thing forward. It's tough for a lot of the tenants who literally can't, they're not doing anything. They're not producing $1 of any inflection in the economy whatsoever. So we're lucky that way. So everybody that's on the phone, I think we all need to be blessed from that standpoint.
Guys, the one thing you're forgetting about is there's going to be an absolute ton of bankruptcies that come out of this, and space that's given back from these retailers, even some hotels. There's going to be a lot of BK that comes out of this because I can tell you the credit markets are just blown up over the junk bond credit market. Yields are ridiculous. So you're going to see a lot of bankruptcies and a lot of space given back. So it's going to take guys. There's been a lot of distressed opportunities because when this space comes back, if the guy's not there to service his debt, he'll probably just give the keys back to the lender, especially if it's a CMBS guy or what have you. So there'll be a lot of space for creative types to go in, especially this mid-box, the big box stuff, and rework these deals because there're just not going to be a lot of these tenants around. And I'd say the restaurant space on the corporate side is going to probably shrink 10 to 15 to 20%. So there'll be some distress, regardless of what happens. There'll be distress.
Will there still be enough debt for purchases to be made, or is this all going to be paused for the foreseeable future? Like, what do you expect for deals that people might need a loan to close, even if they're getting great value on the property? Will there be enough money to actually get the deals closed?
There's always money for good borrowers, number one. Okay, so if you're a big borrower, there's money for you. Right now, it's funny how the world has changed. The pricing's flipped. Now the banks have the most competitive pricing. They could swap into a 10-year deal a lot cheaper than anybody else. CMBS is kind of on the sidelines because their triple B bonds are trading at stupid prices. So they've really, if a guy's pricing you a CMBS deal right now in the threes, get ready for the retrade. But that never happens in that business. And the life company side, I'd say half of our lenders are on the sideline because they don't know where corporate spreads are going. Spreads are all over the place. It's probably not a good time I would say wait a little bit, only because I think corporate spreads gotta stabilize. I mean, they just gotta stabilize. And then I think you'll see the CMBS market come back. You'll see life companies put money out again, but the banks right now, their cost of funds is 0. The 10-year treasuries, I think 56 basis points or something. So if they're doing a spread of 250 over swaps, you know, they're probably at a 3% rate for a 10-year deal. But they're gonna cherry pick for the best borrower in the better asset classes. But there's money out there. I mean, it's not easy to find, but there's money out there. It's how they price it's the hardest part right now, and whether or not you can get somebody to work on it, because everybody's gonna be doing these PPP loans and what have you, or working out getting borrower letters signed. So it's gonna be an interesting month.
Just getting some historic perspective, Tom, a 250 over a 60 basis points is still a pretty sweet deal, huh?
Oh no, but you'd be surprised, Jacques. That's not. There are many guys that say, "Oh no, rates are going lower." I'm like, "Good God, really?" But no, you know, if you get a deal in the low 3s, you ought to take it as fast as it's in front of you.
Right.
You know, I'm lucky. I've got a couple deals closing that we signed up that were in the low 3s for 20-year fixed rate product, but those were issued before the crash. And I think what the key is going forward, I don't know if, I don't do a lot of agency stuff, but I've seen the agencies come across. The deals they're quoting now in a lot of their tiers are requiring a 12-month reserve for payments. So they're a little concerned, you know, when you ask for a 12 months debt service, they're a little concerned about where the multifamily is headed or when they're going to stabilize again. Because, you know, I don't need to tell you guys, we got what, 10 million unemployed in 2 weeks? That's a lot of people. Even those 10 million are getting checks for like 70 grand a year now, but that's still a lot of people. It's you know, this is probably the first time I would say that the commercial real estate market literally changes daily. What's going on? It's so fluid right now. It's almost scary. And the key is to be in the game and to be out looking, because there'll be somebody that panics, that dumps into this market. It always, and it's usually the institutional guys. They're guys that have 5-year funds that have to get rid of their deals in 5 years, so they don't have a choice.
Well, you know, they're changing risk. Yeah, they're changing risk. They're changing risk profile, and that's one of the things. They're changing risk profile. They're changing product type. They're trying to figure out where they're going to be, and also how much more do they think they're going to have to put in these deals to carry these for a period of time, to where you end up having, you know, as they said, anything, you know, we're not going to give you new money for your old deals. We'll give you plenty of money and new money for new deals. And so, you know, what do you really believe this is going to look like in 2 or 3 years from that standpoint? Are you going to get it back to where it was, or are you going to turn around and sell it today, or not today exactly, but, you know, sell it in the next 6 months? Tom's right. You know, we used to tell everybody, let's talk in the next 2 or 3 months. Then it used to be, let's talk in the next month. Then it used to be, let's talk in the next week, the next day. Heck, let's talk in the next hour. And that's kind of what it's looking like.
And Demetri, think about this. If you go in, just take the asset class hospitality. Go in and look at the hotel REITs. Okay, look at the price of their stock today.
80% down.
$3. You know, they're going to have to sell assets probably if this doesn't come back as fast as they hope. And there'll be opportunities in that space, because there are going to be people afraid to go in that space. So the hotel buys, you're going to be able, if you have capital, you're going to get some great hotel buys probably in the 3rd or 4th quarter. I mean, just great. You got to have guts, but the guys that have guts usually make the most money on the rebound. So, and I think the same is going to play for retail. There'll be guys getting out of the retail class after this shock to the system. And the smart retail guys, the guys that know how to work the real estate, will go in and buy some deals that are just in great locations, and either, you know, do a mixed use deal or what have you, and they'll make a killing. So really it's about being in the market and being in touch with people that are in the market and looking for opportunities.
Well, I got to tell you, I'm both Tom and I are getting a lot of texts from a lot of friends and making some fun comments, but you know, I will tell you, it is true. You've got to be in you know, you got to be in the market. You got to be looking at the issues. You got to be looking at the opportunities. You got to be seeing what's happening. So, you know, I think each one of us, as I said earlier, are in a unique position to figure out where the pain is and then where the gain is. If you're a tenant rep, that's one thing. If you're a lender, it's another. If you're a mortgage broker, if you're a real estate, depending on what product type you're handling, you know, I know that we've got a lot of different owners also. And, you know, I think a lot of owners may have second thoughts about certain asset classes or double down, as Tom says, really getting aggressive and doing that. So, you know, and you know, with Jacques, who's a great buyer, who's been looking at all sorts of deals, and he's looked at a lot of our assets. I think, you know, there'll be opportunities. And as I think in the next 6 to probably 6 months, we're going to see a lot of capital and a lot of opportunities and a lot of people who want to partner. One little piece that I won't tell you who, because I don't want to breach any confidentiality, but there's a couple of larger groups that are taking in more money to go into real estate funds right now on the smaller side. I'm talking about the $3,000 to $25,000 investments. And they've never seen such an inflow for this, where everybody wants to participate some way. Now, these are large, you know, multi-global conglomerates that are talking about this, but it's interesting to see how, you know, the market money on the sideline, which there's only 2 asset classes. It's going to go to stocks or real estate, one or the other. And that's what's going to end up happening.
Well, could we talk a little bit about how retail may change with the social distancing and everything that we're seeing now? When we emerge from this crisis, will retail be the same, or is there going to be differences that we'll see from as it was before?
Jacques, I'll leave that to you. You actually own retail.
So I think hopefully this is a 2 to 3 month thing. If that's the case, I think there won't be a big change. I think society would, you know, we're all just trying to get back to normal. So we're all craving social contact. So I think, especially with this support that the government has signed, it'll be back to normal. If it's more than that, even it's a little bit more than that, what worries me the most is the space that is going to become available in the market, because it's not only, yeah, your service retail is probably going to be back pretty easily, but there's a bunch of e-commerce exposure that you know, it's retailers that were already sick, to go with the virus analogy, and this is going to accelerate their death, and probably we're going to see a lot of space available, and that could change the entire dynamics of the market. And not only that, but also like the relative pricing dynamic between asset classes.
I want to add something. You know, our team specializes, as I said, more in clients than the actual product type. So we get a pretty clear picture across office, industrial, retail, somewhat multifamily, but land deals, and some hotels. This is the largest science and social studies experiment ever conducted globally. And I truly believe that we are going to see a lot of changes in how people communicate, how we work, how we shop. So while we are all thriving and dying to go back out and sit at a great restaurant and share a glass of wine and some great food, I think we will do that. But I think, you know, when you start to look at how many people are going to work from home now, and are you going to have flexible office hours? Are you going to have flexible space? Are you going to turn around and are you going to have different experiential retail? How are you going to end up doing certain situations of student housing, you know, from learning, when you look at all these online learning and classes? So, you know, this is, we are seeing the start of this, in my opinion. And I think that in this disruption, I call it the frictionless economy, and this disruption, you know, absolutely, I think, you know, internet sales of retail go up. I mean, we're probably sitting at 12%, somewhere around there, taking out auto sales. You know, 12% of all retail sales, that's just, it's so small if you really think about it. But I think that'll grow. But I still believe retail is here. And if you look at food stores, you look at, you know, all the drugstores, you look at healthcare, you look at charter schools, you look at all these different, you know, just different pieces. I think it's going to be very, very interesting to see how this changes. But I think there'll be some really big bright spots.
I don't know. I'm kind of I'm the guy that thinks this all goes away and we forgot about it. The only thing we'll do is prepare for it maybe next time to where we'll actually have a test, have hospitals ready to go, have, ventilators. I think we are all going batshit in our houses as soon as this is over. We're all going to be at restaurants. We're all going to be at football games. We're all going to be everywhere in top of each other again. And we'll all remember this as a learning experience for the country, that every state and our federal government needs to be prepared for when some Chinese guy eats a bat. I mean, this is ridiculous, okay? I think Barry Sternlicht did it the best on CNBC when he just like, guys, look, people are going to get out of their houses. They're going to travel. They're going to stay in hotels. The key for me is this can't go long. If this goes long, we're going to go probably into a depression, not a recession. And, I hate to say it, but when the kids were in the boats outside of Normandy, I don't think they had an option to get out of the boat. So, in May, I think we're going back to work, whether we want to or not. And because otherwise we're not going to make it as a country. And I think by then, hopefully we'll have enough masks and, ventilators and gloves and everything that we didn't have, and I think this country is smart enough and I think it's strong enough to where we'll be back at work for sure by June. And I think it's going to be more like mid-May. And I think by September, hopefully this is all in the past, but it's a great learning experience. And, I'm hopeful of this, but if it's not, I don't know if we really need to worry about buying and selling real estate, because we might be worrying about, everyone having a job. So that's my thoughts on this. It's a pause for the cause, so to speak. And let's hope in the next 30 days, they come up with better testing, better equipment, masks. I mean, you watch stories where the distributors are selling masks for cash to other foreign countries and stuff. You just sit here and go, only in the US is there a crisis and somebody's profiting from it. So, this is a big learning experience. And what it's going to do, guys, is it's bringing back for sure the pharmaceutical business that the one former administration threw out of Puerto Rico. It's bringing back the pharmaceutical business to the United States. It's bringing back manufacturing of hospital-related necessary products. It's bringing all this back to the U.S. It was a great experiment we had to make it all in Asia, but a lot of this stuff is coming back. That's a need for us, and it's going to be interesting, to say the least.
Look,
The governor of Florida, I'd put a sign out there right now to all the pharmaceuticals. Come on, make this stuff into Florida right now. We'll give you tax incentives. Let's go, because this was a great learning experience of how unprepared we were for something that was a possibility.
look, I would, there's a lot of sentiment there that I agree with, but I will tell you this: whenever there's this kind of disruption and whenever there's this kind of an issue, people will look for opportunities to make changes. And I think people, we're going to see change. We're going to see change. And the change is going to be very minute in some areas and very, very big in other areas. And I think we just all need to be understanding of
So,
what
Mike,
this has done.
Mike, let me ask you a question. Do you think people leave New York City in
Do I
droves?
think people in droves? Well, look, they're already leaving in droves now. They've been coming to Florida, Tom, for the last.
That's a money reason, though.
Okay, well, it's okay. But no, do I believe? Look, people love people, right? I'm a people person. I'm one of those happy, optimistic guys out there, and I'm still optimistic and I'm still happy, and I'm a friendly guy. I love it. I mean, I love being able to be with people. So I think we're all going to get back. But I think if somebody walks in the office and goes, they're going to send them home in shackles, handcuffs, and wrapped in plastic. So I think a lot of people are going to be very sensitive to that as this burns down. And I think it's going to take probably a year or so to burn down, but I believe we're going to take off like a rocket, probably, as you said, in the next, if we can get through this to the end of May, through May, and we go on, we're going to be in a great, unbelievable situation for understanding the magnitude and the speed and the resiliency of our economy. I do believe in that.
Well, they built the PPP for 2 months for a reason. they're expecting everyone to be down for 2 months. So,
Yep, exactly.
like I said, if we're not back to work in June, I think it's gonna be mid-May.
June, how about May 1st?
May 1st is what I want.
Yeah.
Then again, I'm going in the office now, so I'm kind of a freak. But look, guys, it is what it is. We have to deal with it. The one thing you got to understand about the United States is there's a lot of smart people here, and they're going to figure this stuff out in the next 30 days. Trust me. They're not going to have a vaccine. I'm not that stupid, but they're going to have ways to save you, or something to give you, or a test to give you. For all we know, everybody in this picture is happy, okay? Because it's a very asymptomatic virus, and but I really don't think you're going to get a bunch of 30-year-olds to leave their apartments in Brickell because they're living on top of each other and move to Kendall. I just do not ever see that. Okay,
I'm agreeing. That's not going to happen.
30-year-olds, they're not waiting in traffic for an hour and a half to go downtown. So, we all have to be a little realistic about this too.
So
ask a couple questions.
Let's hear them
from the audience.
Oh yeah. So I was about to say we're getting quite a few questions from the audience, so I want to make sure we get to them. I know Mike has a hard stop at 4. So the first question is, how does the CARE Act, we touched on it before, but how do you guys think the CARE Act is going to affect commercial real estate? I've been told that people are hearing 2 different opinions, and I just want to hear from you guys. What's your opinion?
I know a lot about it since I've been working on it myself. Basically, it's 2.5 times your payroll. Okay, so if you do the math, 2.5 times, it's payroll divided by 12 months. So it's 1 month of payroll times 2.5 times. So obviously, it gives you 2 months of payroll and a half of something for something else, and it only gives you rent. Okay, so rent or insurance. So I think it's going to be good for individual businesses. This is where, in my opinion, if you're a leasing broker and you have clients, this is where you need to be right now. Where I'm with my borrowers, the leasing broker should be with their tenants, and they should be in their offices helping them fill these forms out, because these forms are confusing. Okay, so you're talking about 2.5 months. So the guy had an average payroll of $100,000 a month. That's $250,000. He can write all of that off, okay? If he uses that over the next 2 months, for 75% of it for payroll and 25% of it for other things, being only rent, utilities, and health insurance. So there's going to be rent money in there if he wants to write it off. I would think everybody's smart enough to get the loan written off. Therefore, they'll pay their landlord rent. So that's my opinion. The problem is, will the government actually be able to get us checks? That's my curious.
So I want to say one thing, which is different perspective, and also I've got a little different knowledge of certain things. We're going to have at least 2 more stimulus packages or amendments to this, either expanding this greatly for commercial real estate and or the other parts of lending, and this goes across cars, credit cards, all sorts of different things. And it's almost like one big pause button that they're going to have to hit and have a restart. Pause, then restart. So I believe that we're going to have at least 2 more. And I think during that time, we're going to end up then hopefully supercharging. You have to remember something. Some of the people that I speak to, when the president enacted this on March 15th, they turned around and said, okay, most of the rent has been paid for this month. Most everything's been paid. So 15 days is not going to be a big deal. Let's see if we can flatten the curve. Well, guess what? They voted in the stimulus package. The stimulus package right now, the curve is not flattening. The curve was increasing. And when you have an increase in the curve, people are going to turn around and they're not going to be able to get them the stimulus money quick enough. It's going to be weeks before they get that. So 1 more month to help the hospitals, to help flatten the curve, and for us to be able to do our part. I think that's where this 1 month, my opinion is we're all going back to work in May, but it's going to be under some certain guidelines. It's going to be under certain social distancing. And I think the other hot spots, if you will, which would be Miami, New York, and some of the other areas, are going to have maybe some more stringent guidelines.
So let me just ask real quick that you mentioned that if the federal budget is what is it, 4 trillion or 4 point something trillion, and the last stimulus package was 2 trillion, and you're saying possibly 2 more, wouldn't that cause potentially crazy inflation if each one was $2 trillion?
So, for full disclosure, I am a Republican. However, if you want to look at something interesting, go read on modern monetary theory. I'm being serious when I say this. Modern monetary theory is basically where you're just going to print more money. And if you understand the government, our wonderful government, doesn't even have a balance sheet. They don't even track assets and liabilities the way we would as business owners. So if you're going to go out there and have an infrastructure increase of spending, you know, you're actually adding assets to the country. Think about this, the war bonds back in the days, everybody had no idea. Everybody was buying war bonds to show their patriotism. But nobody had any idea if those war bonds were going to pay off, but they invested in the country. We printed more money to be able to do this, to be able to show the country that we can have certain assets. This goes to roads, airports, travel, you know, railroads, you know, ports, all these things that we talk about that help push commerce. We're going to have manufacturing. Think about this, the pharmaceutical manufacturing, all these different things that we're talking about. So while I'm not a big proponent of Bernie Sanders personally, but a lot of people are, modern monetary theory might be one of the things that takes us out of this crazy situation that we're in. And the U.S., by the way, is more blessed than any other nation in this world to be able to control that, to avoid inflation. So sorry to go on a little bit of an economic rampage there.
Demetri, from Economics 101, you're 100% correct. The only difference is we're still you get yield from our debt and we're the safest. When Germany's negative 50 basis points and Japan's 0, and we were paying a point or whatever, it's the best game in town. So if Europe heats up to where their inflation, they can get actually price and credit quality, we would be in trouble. We would be in trouble, or we would have inflation. But until the alternative products are there, our treasury bonds look pretty good. And we're going to have to pay this stuff back. And we can't be in denial that we can't keep printing money. But fortunately, that's going to be your generation and not mine.
Evil. So another question from the audience. What are the key differences between the 2008 crisis and the COVID crisis?
The stimulus package 101, that's the answer. You know, this was a self-inflicted, you know, shutdown for us to, you know, slow down the virus. The last time it was, you know, financial, just rummaging and doing everything else. So I think this time, you know, we're going to see probably, that's why it's going to be a quicker, hopefully shorter time. And then also, I think the stimulus package, which will be expanded, in my opinion, by at least 2 more times, we'll see that kind of help from the government where we did not have that help from the government in the past. So that was the quick answer.
The banks are a lot healthier today. So I mean, you're not going to, it's not a Wall Street driven issue. It's not a financial crisis. It's more of a demand crisis because they've shut us out of going out and buying services and what have you. And that's what I'm saying. The sooner we get released to go back out, the better it is for everybody. The economy was just on fire before this. We're so fortunate that the economy was on fire, because if employment was weak going into this would have been a disaster. But fortunately, employment was very tight, and it's kind of sad because wages, especially for the lower end, were rising rapidly. So this is kind of a self-correction, if you so to speak. But it'll be fine if we can get back to work.
Sure, there's also less leverage, right? Overall.
So let's try to hit 2 more questions before our stop. At what point do you think the banks will stop deferring debt service and start putting borrowers that are in trouble in default?
It'll definitely be when we'll have to be back to work, and I'm guessing we'll be back for at least, I think the first 90 days is a given, that's already out. And I think they got powder for another 90, but that's it. But if we're back to work in May, I would say the first 90 days is all they're going to get. And they might get they might be able to ask for IO after that. The banks have a big leeway. By the way, if you're negotiating with your bank, make sure that when you get your 90 days, to make sure that they remove all your covenants for year end 2020. There are covenants in your loan documents that you need to hit. So when you're negotiating with your bank, there's two things you need to get. Number one, get the 90 days deferment. The second one is make sure they remove the covenants for 2020 and reinstall them for 12/21, because otherwise you're not going to probably hit your covenant, your loan covenants at the end of the year. That's probably more important than getting the deferment, to be honest with you. So, but the banks have a pretty good, the FDIC is giving them a big, they don't want them to foreclose on a bunch of people because of COVID-19, for sure.
And it's up to the regulators, right? Because everything, every single forbearance plan that the banks are issuing right now has to be blessed by the regulators.
Correct.
So if you go back to a bank and tell them, listen, I don't need that much forbearance. I need just convert my deal into an interest only deal. Even if it's a much less aggressive forbearance program for them, they might not be able to do it because it has not been negotiated with the regulators.
Well, it's pretty, Jacques, if you look at the bank, the FDIC passed guidelines, it's pretty lenient to where the banks can almost make the decision and we're not going to hit you over the head come the year end. So it's within guidelines that if the borrower needs assistance, they're allowed to give it to them, based on their, and they're supposed to go, it literally says in the modification, due to COVID-19, we're going to defer this. So and then what they're doing is, and by the way, there's a big difference when your tenants come to you. There's a big difference in the word deferment and abatement. It's amazing how many tenants are coming to landlords with the word abatement, which means obviously no rent's being paid. That's absolutely absurd, okay? If they don't want to pay rent in May or June, they're going to pay that rent. You figure out how to make it up over the term. But to give them a free pass, I can tell you right now, there's not a lender in the world that's going to give you a free pass. They're backing it all onto the back end of the loan, typically.
And here is where we actually see the real value of the aid, right? Of the CARES Act, because many of these tenants, they want abatements because they really cannot, if they get behind 2 months and it's a small restaurant, they might never get back on track, right? They have very slim margins. So with the government's program, then that allows some of these businesses to stay alive and owners to keep collecting rent.
Correct.
Go ahead, Mike.
No, I was just going to say, the main thing is this: the banks are very lucky this time. They were healthy. They do not have to classify these loans, and they don't have to reserve for them, and that is a huge benefit to everybody. And just to tack on what Tom was saying, I think there's 90 days now, and I think there's a possible another 90, and I think that's it. But you never know. I mean, they could be other things that get buried in this. I just want to tell everybody I'm going to have to hang up here because I've got a 4 o'clock hard stop. I want to tell everybody thank you.
Tea time.
No, I only wait. That's at 5:30, by the way. Tea time's at 5:30 down here at Ocean Reef. Anybody? No, I was going to say it really is, very nice to talk with the panels, and Tom and I being friends for years and doing things in Jacques and as Demetri being a part of us. I just want to say thanks to everybody, and also thanks to all the participants. Keep the faith, stay patient, and we'll all get through this together. This is what's going on, and this is how we're running our lives. And we're in a great field to solve people's problems and find opportunities. So I just want to say thanks to everybody. And Demetri, you've been a great host.
Thank you. Enjoy that tea time. I wish I was there.
more conference calls, guys. But there is a tea time at 5:30.
Sounds good. Thank you. Tom and Jacques, do you guys want to answer a few more questions?
I'm fine. I don't have to be anywhere till my bar at 5 o'clock.
Sounds good. Sounds good.
Being here instead of homeschooling kids is not a bad alternative.
Cool. So essentially, with a lot of the more on the personal side of the loans as opposed to the commercial side of the loans, from the deferment and hardships programs, it's still going to affect people's credit. And the question is kind of, do you think there's been enough verbiage told to people that are getting into these programs that a note will be placed on their credit score, or are people, like you guys said, just taking it as a free piece of cake?
It will not be a default on the borrower's credit score. No.
It will not be.
No, because this will be easy. it's different now. The banks, if they worked it out going in, I will say if somebody didn't make their April payment, that probably will not be looked good if they didn't have a deferment agreement before April. So I encourage everybody to make their April payment and work their problems out through April, because that probably won't be looked good. In our shop, for example, our life companies will not enter into any type of discussions until April's paid. So, because again, that's March interest. So, you know, but the banks, most of these guys started working on deferment in mid-March. So, and it will not be, this will be noted forever as COVID-19. So it's kind of a punt.
Cool. And one last question. I kind of agree with this as well. I know that you guys had said you don't see people leaving Manhattan and leaving Brickell. I actually read an article that said that, especially in the New York area, all the people under the age of 30 that's parents lived outside of the city, it was like 90% or something, left Manhattan to go into Westchester, Connecticut, New Jersey, the suburb areas. Those areas, also due to tax reasons, the real estate values have been completely slashed over the last 10 years. Do you guys see an opportunity for development around the outer rings of major cities? In Miami, it might be a Coconut Grove and Aventura, as opposed, or even maybe up to Boca, as opposed to in the major urban cores. Miami might not be the best because it's a really spread out city.
Miami's a horrible example. The outer rings Homestead. So, I mean,
Mm-hmm.
you know, that's only a 2-hour commute, I think, into downtown.
Yeah.
You know, I think there'll be some people that go back to the burbs, but at the end of the day, I think the one thing I wonder is how do the condos do? You know, from what I hear from some of my friends, you're basically locked up in your condo because you can't go to the pool, you can't go to the gym. So how does that asset class do? You know, for me, I live in Pinecrest, so this has been great. We have an outdoor pool. You know, we have a decent sized house. So I mean, we're on an acre. So we're closed in, but we're not closed in. I'd probably kill myself if I was in a condo right now and not be able to go anywhere. So that's a good question as how are the condos going to do? And, you know, I don't know, guys. If you look at Florida's statistics, we're either really late to the game or the heat has something to do with it. And let's all hope it's the heat, right? Because if it's the heat, then I would see Florida's growth even accelerate, you know, to be able to live next to the water, quality of life, food, nightlife, and maybe not as big a virus scare. That's not a bad gig, you know? So as far as New York City, I don't know. I'd have to defer to New Yorker because the city's special to a lot of the New Yorkers I know. So, but I don't know. It might change people, but maybe the older people. Maybe that's what it changes. The people that are over 65. People close to my brother's been looking for a shout out. People closer to my brother's age.
I think we have very, very short-term memory. So really having people move out of condos and go to the suburbs just because they remember that they were at some point contaminated by clicking on the same elevator button than someone else that was infected I don't see it happening.
Great. Well, thank you very much, guys. This was a great discussion. We're going to try to get some more webinars going while we're all stuck in quarantine. So keep an eye out on Profile, keep an eye on your emails, social media. Thank you, Tom. Thank you, Jacques. And everybody be safe and be healthy.